Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. Today we have David Cruz-Palmer with us from Corridor Capital Partners, all the way out there on the East Coast in Virginia. David is an industrial expert, which is super exciting because I have been up on industrial recently. So David, thank you very much for hopping on the show.
Good to be here. Thanks for hosting.
Absolutely. I told you before we got on here, we like to start with stories. We like to hear how people got to where they are today. So why don't you take us back to the beginning? How'd you get started in real estate?
Sure. Yeah. I dabbled a little bit in real estate in college, was the worst mortgage broker in the world for about 6 months right out of college. And then about 2 years after getting a real job where I learned how to do cold calling, I found my way into being a commercial real estate broker. So I was a tenant rep commercial real estate broker in San Francisco for 15 years.
Oh, nice.
Yeah.
A tenant rep. So you helped like lease up properties?
The exact well, yes, sure. So I worked with tenants or occupiers of commercial space and represented them in the finding and negotiating and procuring of leases generally. So not a lot of acquisitions or purchases, but yeah. So like I was in San Francisco, lots of tech companies.
Yeah.
Lots of financial institutions too, and help those companies find the space, negotiate business terms, work their way through the lease. Yeah. And then you kind of ride the wave with a company going from 2 founders to, 100 of people or hundreds of people or thousands of people. Figure out real estate strategies across the country. Yeah, that was it. So read hundreds or thousands of leases and used that to find my way into syndicating commercial real estate investments with a heavy focus on industrial.
Nice, man. I was thinking, that must be a perfect segue into industrial. Those leases are just massive. And so being able to just know exactly, it sounds like you were just helping businesses find good spaces, negotiate their leases, all that stuff over and over and over again for a number of years before you got onto the investor side, which is a good framework for sure. Yeah.
No, it's funny. Typically it's, you would think that having sales experience would be valuable, but I actually think the leasing experience is certainly as valuable because I understand it from a tenant's perspective. I understand what a captive tenant is, right? One who can't leave because they don't have any options in the market. And I understand when there's a soft market, right? So from a tenant's perspective, you want to take advantage of a soft market and get the best economics that you can. So that's the backdrop of, my foundational knowledge that I try to use and apply to the investments that I look at with my investors.
Absolutely. And so when did it sounds like you're a broker helping with leases for quite a while. When did you first make the jump from, broker, leasing agent to investor? Now I own this property. I'm trying to lease it out myself.
Yeah. I had some time for a couple of years.
COVID
during yes, exactly. During COVID, had a couple of years too. It's funny. I feel like all brokers say this thing. They're like, "Oh, you're on the principal side now, like you're living the dream, right?" And I agree with that. And I've always said that I wanted to own real estate. And you deal with it every day. But when you're a broker in San Francisco, like I did 400,000 square foot lease in South San Francisco. I did 100,000 square foot leases for these companies. They're huge, but and the commissions are great, but not nearly great enough to buy a commercial property in San Francisco, right? Like a house in San Francisco is bottom of the barrel is $2 million, right? So you could imagine buying like 100,000 square foot facility or just something else. Like it's just on another scale. So you say you want it, but you don't really see it. But now I'm in Charlottesville, Virginia, right? And the brokers kind of still say the same thing, and most of them don't own properties. And it's just this weird. It's like a mindset thing. It's a leap of faith thing. For me, it was I had some time and I had a couple of good years, like going into COVID as a broker, and it's like, all right, I want to buy something, and you realize like you can't buy that much. You need a lot more money to buy something bigger, to buy the thing you want. And then it's from there that I figured out what syndication was and raising money from friends and figuring out how to build a financial analysis with a waterfall structure and GPLP and just all the market analysis stuff. But it was from a different perspective. But a lot of great podcasts out there where you can learn about these things. And then, the internet has everything's readily available, great books. And then you talk to people who have done it. So, I did kind of a crash course in syndication and bought my first 2 properties about a year ago and raised money with people. And I've in contract on a pile now and got a bunch more down the pipeline. I built a system for finding off market properties, which is, something that a lot of people would, do in the single family and house flipping space that I've just been using some of their techniques and software infrastructure to do what I'm doing now.
Perfect, man. You're in good company. So your first deal was actually a syndicated deal. You didn't buy it with your own cash.
Nope. Yeah. First one was a 250,000 square foot warehouse off of Interstate 81. Yeah. In Virginia. And right at the same. What's that? Was it
like was it Class A or was this like run down? You needed to fix it up, all that kind of stuff.
Yeah, former federal judge and his wife owned it and ran it. She'd owned it since the 70s, and she passed away a couple years before. And he's old, and very retired, and just didn't want to be running it, but didn't know what he wanted to do. But he was waiting to see maybe his son wants it, and he's kind of running it in her memory. And it was just more than he could handle. And the son was an attorney in North Carolina. He didn't want to run it either, so he got it off market at an 8.5 cap. It's rail served with an active rail spur, and I have a Fortune 500 tenant in there with a lease that's expiring 24 months from the date that I purchased it. So usually with commercial leases, you start negotiating those anywhere from 12 to 18 months in advance. But in a very tight market with industrial has a 3% vacancy rate, pretty much drop a pin in the map in the United States, and somewhere between a 3 and a 4% vacancy rate. So wow. So the model and their rent was fixed. It was gross, no annual increases. And so, naturally, there were rent escalations that would increase the rent they pay. And right, the rent they pay it's NOI, right? It becomes NOI. And so to renew the lease is to increase the rent, which is to increase NOI. And so that's the value add or whatever structure, right, for most of these commercial properties.
Perfect. So, that was an awesome explanation. But, people that aren't into industrial, there's a few, for everybody listening, there are a few terms that I just want to clarify. You said gross leases, that's as opposed to triple net. And so
or anything in between. Yeah.
Yep. And so they were paying, you still pay all of the expenses for the property. But you're saying that one of the value adds for this property that you purchased is transitioning it to triple net.
Correct. Yeah, that's right. And so that's actually a strategy that I use now a lot, that is available to commercial, right? That isn't so available or isn't available really at all for multifamily or maybe even self-storage, is to change the lease structure. As I mentioned, the vacancy rate is very low. The United States we haven't built enough industrial space for the demand that we have. And there are a lot of macroeconomic things going on right now, like China shutting down for months at a time, that make companies that do manufacturing and shipping and receiving, and they want to have a little more predictability in the supply chain. So there could be a lot more pressure on industrial space, which would keep demand really high for many years to come. And with 7%, 8%, wherever interest rates are going, there's not a lot of spec development going on to meet the demand, the current demand. So most of the spec development is either in these really hot markets like Savannah or LA, where they're massive ports, but most of the development's actually just coming from build-to-suits for companies that need space. So they'll partner with a developer or do their own. So something between those two, or someone that owns dirt cheap land and they're just going to bite the bullet on the cost and hope to hit the high rents that the market, the market has really high rents because vacancy is so low. So, if rents have gone up, Prologis is the largest industrial landlord in the world. And their rents have gone up something like 20% year over year for the past 3 years. Jesus. So you can imagine, what does that do to your bottom line? It does great things to your bottom line. And if you buy a building, like those, and the rents have just escalated in one of these really hot markets, you buy it based on a cap rate, and the cap rate's based on NOI, and the NOI is based on the next 12 months of rent. And so like landlords know this, right? You'll still buy a building at a 4.5 cap sometimes because supply is so low, and there's this capital event coming up because they know that in 2 years the lease is going to expire. There's a guy in Richmond I talked to. This guy wanted to sell it a 4.5 cap because and this is not, none of these are like credit tenants. These is just, he has 100,000 square foot building, and he has 2 tenants, and one of them's paying $5 a foot. The other's paying something like $450. They're both triple net. They both have 3% annual increases. And the one that is paying $450 has a lease expiring in 2 years. And he's like, hey, I want $6 million. And I did the math. And that's like a 4.5 cap. And the inside of the building's nice, but it's a dirty building. The ceilings are not high. It's nothing special. It's just that there's nothing else available. And he's like, I offered $4.5 million. He's like, no way, I need 6. And I said, that's a 4.5 cap. Like Amazon doesn't even get a 4.5 cap right now, just because rates are so high. He's like, well, I have a lease expiring in 3 years, and it's going to be $6 a foot. And I'm like, okay. And I did the math on that, and that's a 6 cap. I'm like, I'm not going to buy a future forward 6 cap where you just bake in the value. But he's not wrong. And to be perfectly honest, Richmond, Virginia is one of the hottest markets. It has the highest leasing velocity for industrial space of any city in the U.S. right now. And a lot of that is because of the demand around the port, down in like Norfolk area, Virginia Beach area. So his rents actually could be like $7 a square foot. So if that's the case, then it might be worth it. But I'm not like in a position to take that risk right now. Certainly not without something like seller financing.
Yeah, and especially for, I'm assuming you and I are both, we're not on the $100 billion. We don't have a shit ton of capital that we can just throw around, and so I just cannot deal with sellers who want pro forma rates. They're looking at a 4 cap on close, but they're like, oh, in 3 years it's going to be a 9 cap. Well, I'm not going to buy something that's going to lose me money in the interim.
Yeah, I mean, 9's better than a 6, but yeah, I'm with you.
Yeah, yep, that makes sense. Cool. So just for people who, like myself, who are not in industrial, they want to get into industrial, what are the things that you look for in these properties to identify like a really good deal that you should be closing on?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Sure. I'll tell you a couple things. One, I actually have a sheet that I put together for evaluating industrial real estate leases. So you and also just industrial properties generally. There's 2 sheets. I could share both of those with you.
Yeah.
Well, what you should look for is, what are the market rents? Who are the tenants in the building? And then you really got to, for a lot of people who do go from multifamily, there's a different underwriting process and different set of assumptions. Everyone kind of understands a house and the rents and the costs associated with the house. And I feel like if you haven't done a lot of commercial, then maybe you're not familiar with the lease. And I feel like a lot of people are into multifamily, one, because they're just really great returns if you can, get the ARV right and get the assumptions on the renovation costs right. And inflation is, certainly a valuable contributor to the increase in rental rates and the shortage of housing. But those are the things that you look at when you look at multifamily. When you look at industrial or commercial generally, you're looking at the fundamentals of the market as they compare to the rents that are in place. So like office is really rough right now because we don't know if people want to be in offices. there are a lot of jobs that are being sent to other cities. So like if you're looking at suburban office, class B office, that's just a really rough asset class. Industrial, though, is pretty strong. So you want something that has the highest ceilings you can possibly get, 20 feet or more, ideally 30 feet. Because
so 20,
that's
if you're looking at a minimum, this is, clearance is something that's a new concept to me. And so for industrial, as I understand it, 20 feet is the minimum that you would want. Anything under that.
Yeah, I mean, you can get away with 16s. I've got a building with 14s, and I'm having a really hard time leasing that space. So, like, makers can go in there, but you're not going to get the industrial tenants that you want. You can try and raise the roof, but a lot of times there's like a sprinkler system, and it just gets too expensive, and it doesn't necessarily justify the cost. But it's an option. And so you want to get decently high ceilings. I'd say 16 to 20 feet at a minimum. It really depends on the market. I'll also say that I look at flex warehouse space, and what that is like that's where the guys who are doing like
party
the
in the front, mullet in the back.
Yeah, sort of. I mean, less of. I actually think more. Yeah, that is the definition of it. But there's a version of it that doesn't always have the party in the front. Sometimes you have the office for like people to come in and do a retail thing, but it's mostly a roll up door, the highest ceiling you can get, and then they're just storing things. It could be like rug sellers. It could be like just people who do things as a service, and they have trucks that need to come and go. Like, I don't know, like the people who sell you salt for your wells, right? Like there's so many of these random things that
people who
that need a roll-up door.
Wedding furniture,
Yeah, no, that's exactly right. The people who put water bottles in your office, like there's an unlimited number of these. There's a very large number of people who need a roll-up door and some space, like 2,500 to 5,000 square feet. And there's a real shortage of that space too. And that's like the stepchild, the ugly stepchild of industrial. And it doesn't need to be. It's just that you don't get these really high credit, publicly traded tenants in there. But there's so much demand for that. There's never we're always going to have plumbers. We're always going to have carpenters. Even in like a down economy, there's going to be someone who needs that stuff. And similar to the self-storage or maybe the multifamily, those leases are usually really short. They're like 1 to 3 year leases. And that means that you can take advantage of inflation. So you can turn those into a triple net lease and go where the tenant pays for the taxes, the insurance, the operating expenses, right? And you can pass those on to the tenant, and then you're just getting rent. So if you see the economy's getting rough, you have the option of making the lease terms longer with 3% annual escalations. And maybe the average recession is 2 to 3 years long. So maybe you do 5-year leases and you try and skate over it, or maybe you don't. If it's like this weird thing we're in now, right, where we've got who knows if it's inflation or stagflation, and so if expenses go up or rents are going to go up with inflation. It's just the cost of everything gets higher, and then real estate values go up. So there are a lot of opportunities. I could probably go on and on about the different things to look for, but I think if you're looking for classic industrial, I would look at high ceilings, a good location, something that's valuable, and then the quality of the tenant. I think those are the top 3, or the potential quality of the tenant if it's a vacant building.
And for location, as I understand it, you're looking for, obviously port cities are massive, but those are also going to be super expensive. Outside of that, you're looking for major metros along highways, right? That's basically what people are looking for when it comes to industrial.
Yeah. I mean, it could be a mix and match, right? I actually think there's a lot of value for small cities along highways that are well located, kind of like a stopping manufacturing point. Like where I live in Central Virginia, there's a highway that connects. So there's the 81 corridor, which is sort of famous for like Scranton, Pennsylvania.
Oh yeah,
and Pennsylvania has
right.
So like exactly. Well, the Lehigh Valley in Pennsylvania is this I don't know. It's like this place that's had way more industrial development than anywhere else over the last few years, and that's along 81. But Virginia, that 81 goes straight down into Virginia and connects to I think it's Knoxville, Tennessee. And so in Virginia, we've got these little cities like Waynesboro and Stanton that connects where 64 goes to Richmond. It crosses through Central Virginia. And so it goes from Richmond, Virginia to 81. And Amazon built 1 million square foot facility there to do a distribution of it, just opened this year. So like it's under the radar, but also Amazon, who is building things there, right? Like that validates a hypothesis, and this isn't one of the ones that they're shutting down. This is the new long-term vision for Amazon, and it's not even last mile. It's just really well located. Yeah, so that's like where
funny.
highways meet. Yeah, even if it's small cities, I think that's even valuable, and that's actually more under the radar if you're looking for something.
In mobile home parks and self-storage, I use kind of a rule of thumb that if there's a Walmart within 10 miles of the location, then it's probably a good buy. So for industrial, it sounds like if there's an Amazon warehouse within,
yeah, I mean,
it's probably well located.
Yeah, I think that's probably an obvious one, right? for most people, right? That was like buying residential next to Starbucks or Whole Foods 10 or 20 years ago. Yeah.
I love it. Cool, man. Well, I've loved everything you shared so far. Wish we had more time. We have passed through our initial section, so it's time to jump into the quick question round. Are you ready?
Do it. Yep.
Let's do it. Starts with books. 2 recommendations. You can be books. It can be any form of education, YouTube videos, whatever. But give me 2 of them. Give me 1 for general life wisdom and 1 for real estate specific.
Cool. I'll just grab the 2 I have here. Vivid vision is great for kind of like putting together the vision and like what is it that you want to do? What do you want to build? Cameron Herold's he wrote a great book, and I know lots of people who go back to that year after year to make sure that they're focused on the long term. Currently, I'm part of this Raise Masters thing, and Rob Beardsley is one of the mentors. He has structuring and raising debt and equity for real estate. It's really well done, incredibly well done.
Rob Beardsley. All right.
It's I mean, it looks like this boring, like, I don't know, thesis paper. And
like a law book.
It does, but it's easy to read. It's just like, it flows. He did a really great job.
Yeah. Well, for a subject like structuring debt, it shouldn't look super fancy. It should look like
I think he got excited about the equity because the transition was now we're done with the debt. Let's get to the fun stuff. So, but I mean, there's a lot to consider. And I learned a ton reading that. I'm reading it the second time right now. Yeah.
Perfect. I'll have to pick that one up. That moves us to the next question. This is for your younger self. So if you go back to the David, who is, let's say he was just getting out of college, he was a mortgage broker. Go back to him, look him in the eye, give him 1 piece of advice moving forward.
Yeah, it's 2 things wrapped in one. It's take lots of risks and trust yourself.
Great advice. Take lots of risks, especially when you're just getting started, because those are the times when people forgive you the most.
Yeah.
All right. And next question. This is your Superman strength. We are all gifted with unique strengths that we give this world. So what is your Superman strength?
It's something like I think people trust me. I'm just honest to a fault. And I also can get super focused on things. Like when there's a thing that I want, I can make it really consuming for me, so that it's the only thing that I inhabit for extended periods of time.
Perfect. If you want to hit a goal, obsession is definitely a way to do that. In fact, it's almost required. If you don't have that super focus, then it's not going to happen. So great strength. That moves us to the next question. And this one is mentors. None of us are islands. We all stand on the shoulders of giants. So who is one mentor who has contributed tremendously to your career? And give me a shout out.
Sure. Yeah. I actually, this year I hired a coach, which was kind of a leap of faith for me. I didn't want a mindset coach. I wanted a business structure coach to help me figure out real estate deals and things like that. And then I got a mindset coach. And this guy, his name's Chris Patterson. He's awesome. He works with lots of amazing people. Michael Chandler in the MMA is one of them who's fighting this weekend.
Nice. Right on. Well, shout out to Chris. Thank you very much for helping David along his journey. That moves us to the next question. This one is location. The U.S. It's a big place. A lot of opportunity out there. A lot of square miles to buy. So, what is one metro you are most excited about investing in today?
Yeah, it's Richmond, Virginia. Hands down. Yeah.
Backdoor investing.
A lot of upside.
Yep. All right. Second to last question. This is. I'm losing it. There it is. Tools form the backbone of every business. So what is one tool that you could not live without?
I think without saying things like the internet, I'll say CoStar is just really valuable. Yeah.
That's funny. It's funny you say that because I am just now, I used to use self-storage as my main thing, and I used Track IQ, which is it's like a CoStar, but just for self-storage. But I've been wanting to get into other asset classes. And so I have a call today to talk with Crexy. But I've heard people have been throwing shade at Crexy, and they say that CoStar is the way to go. Do you have experience with both of them?
I do, and Crexy's great. And I just yesterday emailed the Crexy guy back, and I was like, "I'm sorry, man. It's just CoStar for me." I will say that Reonomy is hands down, the user interface for Reonomy is like nothing I've seen before. It's the experience I want. The data is just not as good, and it hasn't been there as long. It's great. It is so the things that are the same as CoStar are better. It's a better experience, but CoStar just has so much of a head start on its data that it's not really fair. They've been a publicly traded company since like 1999, and so they've been collecting all of this MSA data and aggregating it and populating it into their database. It's just like the historical data that they have, and the fact that they're still trying to be the leader. I mean, they are still the leader and the most competitive, gives them an advantage. Let me know if you want to go in, because I'm actually about to get a new license.
Nice,
Let me know if you want to go on a license together. You buy them in bulk, and you can actually get a better price.
For
Maybe
sure.
We'll get some listeners in on this too.
We'll have to talk after the show. That's something I might be interested in. But it's good. CoStar, I'm glad you said that, because I was really torn between the two. Crexy's definitely cheaper, but I've heard
do the Reonomy free week or whatever, just to see how nice it is.
The UI. I'm a sucker for a good UI though. It's like if you get good. Yeah, if you get that, then I'll be happy about it. But all right, that's your answer for the tool. Great one. That moves us to the very last question. This is for the listeners. You've given us a lot of good advice. I'm sure people want to reach out and learn more about how to invest in industrial. So why don't you tell us the best way for them to reach out to you? Sure.
So you can find me on LinkedIn, David Cruz-Palmer. Cruz is CRUZ, and also David at corridorcapitalpartners.com.
Perfect. And I will put that in the show notes. So if y'all want to reach out to David, just click a little more in the description. It'll pull down the full description, and in there you can find David's URLs. All right. Well, hey, man, that wraps it up. Thank you very much for hopping on the show.
All right. That was great. Thank you.
Absolutely. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to show us some love, the best way to support us is just to leave us a review on Apple. That is the only thing we ask. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.